everyone. My name is Michael Robillard, and this is The Evolving Trader. We are back with part 3 of a basic and effective technical analysis. All right. If you haven't had a chance, please take a look at part 1 and 2. We are going through a series that is designed to be life-changing. Life-changing. If your goal is to be financially independent, we are giving you the plan on how you can do that through the stock market by showing you how to set up a basic and effective technical analysis setup. Before we go any further, please take the time to like and subscribe down below, and also hit that alerts button so that you do not miss not one video of this awesome series, a basic and effective technical analysis setup. We will be going through this. By the time we are done with this series, you will have all the tools that you need to be successful in the stock market. Now let's move on here over to our disclaimers. Once again, this is all for educational purposes. Please evaluate your life, your financial situation, and the amount of risks that you can take. All right, now that we got all that over with, if you want to read all of this, definitely take the time to pause this and read the disclaimer fully. But let's go ahead and jump in because we do have a lot to cover today. What we will cover today, we're going to go into the 5 styles of investing, 5 styles to invest with, approaches of investing, and we're also going to go into what trends are, being able to pick up trends, and then we're going to go into candlestick chart time frames. All 3 of these subjects are going to bleed into each other, and by the end, hopefully you will have a good understanding of all 3. So let's go ahead and get started here. Trading style number 1, investment trading. Investment trading is probably one of the most secure styles of investing in the stock market. You're buying a position and you're holding it for at least a year. Most people that go into investment trading are doing so for retirement. They want money for retirement. A lot of people go into investment trading as a way to steadily grow their net worth. That is what investment tradings are mostly for. It does have unlimited profit potential, and I'll show you that in a minute through a stock chart. There isn't really, most of the people I know, including myself, that get into investment trading, we kind of have an idea of how much money we want, but we don't have a set number. We're not saying, okay, when the stock reaches this. Now, I do have certain stocks that I've invested in right now where I am looking for a set number. For example, right now I have Apple, and that's one of my investment trades right now. I bought Apple right before the split, which got me with just under 50 shares. I think it's like 46 shares. And so I'm expecting Apple to get back to $500 a share, $600 a share before I even consider selling those stocks. Same thing with Tesla. I'm hoping to see Tesla jump back up to $1,500 before I consider selling it. But some of the other long-term investments I got, I really don't have a time frame for. I really don't have a set number. I just know that they're good companies and the stock has been steadily going up. The other thing, when you're investment trading, you're going to use what is known as fundamental analysis and technical analysis. At one point, people were mainly doing fundamental analysis for investment trading. This is how Warren Buffett became a billionaire, through fundamental analysis only. What is fundamental analysis, you say? Fundamental analysis is when you are looking at the bottom line of the company. You want to know who the board members are. You want to know what their income looks like. Are they making more money each quarter? Are they losing more money? Are they cutting edge? Who are their competition? The list goes on and on. You get all of this information, and then it gives you an educated decision in knowing which company to invest in for the long haul and which ones you don't. Nowadays, most people do a combination of technical analysis and fundamental analysis when it comes to investment trading. But at one point, it used to be just fundamental analysis. Usually, when people are investing in the for the long haul, unless you have done a very thorough fundamental analysis looking for an off-brand company that, looking for that diamond in the rough company, usually you're going to stick with well-known companies, household names, Disney, Microsoft, Apple, McDonald's, Walmart. People tend to stick with companies that have a proven track record that most people know, you're comfortable with, it's not going to go anywhere. Once again, that's not always a guarantee. There is no guarantee with the stock market. Back in the 70s and 80s, Blockbuster was the thing, and I'm pretty sure that nobody who invested in Blockbuster expected it to be gone by this time. But as we know, Blockbuster is no more. So you do have to pay a little bit of attention to your companies that you're investing with. Now, let's look at some downside to investing strategies. Your money is locked up. Honestly, that's the only downside I could really come up with. Your money gets locked up. Also, if you're not careful, you can lose everything. Once again, Enron, another example. A lot of people lost money, lost their investments in Enron. When you hear people losing their money, Enron is a good example. They thought it was going to bounce back, but it never did, and millions, maybe even billions of dollars were lost. So that's another downside. Always pay attention to the news. You don't have to babysit the stock so much, but you do want to keep an eye on what's going on in the news, because one bad thing could ruin the whole thing. Now on the upside, it has the greatest earning potential, and I will show you an example of this right now. Let's go to our stocks here, and I like to use a company called WWE, and I'm going to change our time frame here to 10 years, 1 month charts. Okay, so let me see. Okay, this is good right here. Let us look at this time frame right here. All right, and this is, as you can see, oh, wait a minute. This is May of 2016. So basically within May of 2016, the stock was as low as 1669 and went up as high as 1842 within that month period, right? Let's look at how the stock did a year after that. So we're at May of 2016. Let's go to May of 2017. So here we see at some point it bounced around 1922 and 2210. So you just made profit within a year time. But you don't have to stop there with investments. You can keep going. Once again, like I said, most people use these to build their net worth or for retirement. So when your money is in there in an investment, it's usually there for a while unless there's a reason to pull out, right? And in this case, look at what happened to the WWE. Let's go another year. 18. look at what happened 2 years later. In May of 2018, now you're looking at a low of $38 and change up to as high as $60 within that month of May. Wow, this is the benefit of investment trading, folks. You keep your money in there. This is how Warren Buffett became a billionaire, starting with just $10,000, constantly getting into trades that go up like this for the long haul, holding them for a year, 2 years, 5 years, letting them go up consistently. This is the benefit of investment trading. All right. Now let's look at another upside. Another upside is that it survives the ups and downs of the market, right? Let's go back here. As you can see, from the time that we started in May of 2016, it had some downsides, right? Upsides, downsides, but we were able to ride the waves even still. So when you're going in with an investment, if the stock starts dropping a bit for a couple of, in this case, you can see it dropped 3 months in a row. It dropped 3 months in a row from April, May, June of 2017, but there was no reason to concern. You can afford to let it drop a bit. You know it's going to drop. You expect it to drop, but the upward trend. The WWE at this time frame, to me, was like the perfect long-term investment. Had I had the wherewithal to get in on it, I would have. All right, so now let's move on to the next trading style. The next trading style is called position trading. Unlike the investment trading, this one has a more concrete time frame. Usually 1 month to a year. Now keep in mind that these time frames are not etched in stone. Depending on who you talk to, they'll give you different time frames. Some people can say 3 months to 6 months is considered position trading. And the reason for that is that most of the time when you're position trading, 3 months to 6 months is how long it takes for you to reach your target profit. All right, so like I said, it's not etched in stone. I say 1 month to a year. Some people might say 3 months to 6 months. I don't think to me, it's potatoes. All right. Another thing that makes position trading different, you end up using more technical analysis than fundamental analysis with position trading. Like I said before, you actually have a target price. With unlike investments where you don't, mostly you can have target price. Now, once again, this is a very conservative target price here. Some people might say anywhere from $20 to $50 upward swing would be considered a position trade. I tend to be more on the conservative side, but if you want to adjust these numbers to make it fit you, you're more than welcome to do so. But that's usually my target price when I'm doing position trading. Now let's look at downsides. Once again, just like investment trading, your money is locked up for however length of time for the trade. Also, position trading are susceptible to sideways markets, right? Let's go back to our WWE example. As you can see, before WWE took its huge upward swing, it went through a period of sideways markets, right? So if you are position trading and you see that the stock is stuck between a certain price range, at the end of the time frame that you have, whether it's 6 months or a year, you have to reevaluate. Do you believe that the stock is going to get higher? Do you think it's going to go up? And if so, then you might have to make the decision from switching from a position trade to more of an investment trade. I'm pretty sure a lot of people within this time frame had to make that same decision, right? So you know, just be aware that sometimes you might fall into that sideways market, and you got to make a decision then and there. All right. Now let's look at some upsides to position trading. Your money is not locked up for too long. Yeah, your money is locked up, but you can take your money out, normally making profits anywhere from 3 months to 6 months on average, sometimes up to a year. Another upside is normally position trading can withstand market downturns. So you have flexibility with the stock if it's going down. Definitely have flexibility there. Another upside is more consistent profit making money within the year on a more consistent basis. Definitely a good upside. All right, so next we're going to jump into swing trading. This is the style of trading that I mostly do, is swing trading. Now with swing trading, you're looking at a stock that you are holding on to for more than a day to up to a month. With swing trading, there's also a profit target. Like I said, I'm pretty conservative. You might change these numbers to $10 to $25. You gotta be more realistic. With swing trading, this is where you want to really look at the history of the stock that you're investing in to determine where your profit is gonna go. Let me give you an example. Going back to here, let's look at another company. Let's look at AMD, and this time I'm gonna change this to a 2-year 1-day chart. And let me back this out a little bit. You can see a whole lot of movement with AMD. So when I'm looking into a company to possibly swing trade, what I'm looking for is what their average volatility kind of sort of looks like. There is no rocket science behind this. Trying to look for a good range here. There we go. This is good. I like this. Okay. So what I'll do is I'll go back, and basically what I'm doing here, I'm looking at this trend of here. A short uptrend, right? So $41 around at the bottom, up at the top, $42. Okay. And I kind of do the same thing, going down, $42.95 to around $41.60. Okay, and then I'll keep doing this. I keep looking at these trends, downward trends, upward trends. 43.81, 42. Okay, so the question is, and then here's another upward trend. I'll do a few of these. I'm just gonna do a couple here. Normally I would keep going, but for the sake of time, I'm just gonna give you a rough idea. So here's another one, 42.03, 43.27. So it's safe to say roughly around $2.50 to $3 would probably be a target that I would choose. Now, of course, you got these swings right here that goes real high. So my hope, and then you got these right here. So I'm looking, but I don't see these, right? This is let's say that the stock stopped around here, right? That this was the last day of this chart. So I'm looking at these past history to make a decision on how I feel like this stock is gonna perform, and that's how I pick what my target price will be. And once I have my target price, I will set my stop loss and my limit. Okay, now going back to the chart here, let's look at some downsides. With swing trades, you're susceptible to after hours volatility. I have fallen for it a few times when I've gone to a swing trade and overnight something horrible happens. CEO gets caught in sex trafficking ring. Some type of scam is taking place and the whole board of directors is in on it. Money starts dropping like crazy, or God forbid something like people are still sore with Bill Cosby. Let's say Bill Cosby gets on the board of a certain company overnight. Bad news overnight can hurt you in this. So you always got to be leery of after hours volatility and bad news that takes place after hours. Another downside is more strict guidelines for downward changes. Now, of course, you can be lenient with your downward changes, but you don't want to be too lenient because you don't want to lose all your money because it might not recover. Most of the times they do, half the times they do, but we're not trying to predict the stock market here. We're looking at the charts and making logical decisions based on how the stock behaves. Now let's look at some upsides to swing trading. Potential for multiple monthly incomes. Now on average, my swing trades is usually 2 to 3 weeks. So each month, on average, I'm making profit once or twice a month. Sometimes I'll run into a real good trade where I'll make a profit within 3 days. I'll reach my profit target within 3 days, sometimes within a week, sometimes within 2 weeks. But it's usually 2 to 3 weeks for my swing trade positions, and I'm making money. Another upside is setting up stop losses and limits. We will go into deeper details of stop losses and limits later on in this series, but just know that setting up a stop loss is how much money you're willing to lose on the trade, and the limit is the profit target that you are looking for in the trade. I do these very frequently. Never go into a trade without a plan. Unless, once again, you're investment trading and you're just in there for the long haul. But with swing trading, you never go in without a plan. Never go in without a plan. Okay, now let's move on to trading style number 4, which is day trading. Day trading is one of the most exciting styles of trading, and one of the most popular styles of trading. When you're day trading, you're holding a position for about 15 minutes up to 6 hours and 15 minutes within that day period. Like I said, it's one of the most popular styles of trading. Normally, like I said, these are my personal numbers that I look for when I'm doing these things. Very conservative. Some people are looking for $5 to $10 for their profit target. Like I said, I'm very conservative, and what I'm looking for in, out as quickly as possible is my thing. Now let's look at some downsides. Okay, with day trading, most beginning traders fall subject to what is called the PTD rule, pattern day trader rule. This is a rule that was set up by the SEC to protect novice traders from losing their money instantly. The SEC believes that unless you have $25,000, you should not be day trading on a regular basis. So they've limited the amount of day trades you can do. So under the pattern day trader rule, if you have less than $25,000 in your securities, you can only make 3 day trades within a 5-day period. If you go beyond that, your account will be locked for up to 90 days. You will not be able to trade or do anything. Now, depending on your brokerage, if you fall into this one time, they might let you slide and remove the lock from your account. they might not, depending on the brokerage. Also, depending on your brokerage, if you fall subject to the PTD rule like 3 times, it's like a 3-strike you're out deal. But once again, that all depends on your brokerage. So that is one thing to definitely pay attention to. If you are not starting with $25,000, if you don't have $25,000 to start with, day trading may not be the thing for you. You may want to do more like swing trading, position trading, and investment trading until your account gets large enough. Then you focus on day trading. All right. Now, also, one of the downsides is smaller income per trade. Like I said, you're not looking for that big number as you would with position trading or with swing trading. You're looking for a smaller profit target with day trades. So a lot of times, to offset that, you got to have the money to trade a whole lot to offset that if you're going to be day trading consistently. Very strict downturn adherence. Although there is some wiggle room for the stock to go down a little bit, you don't want it to drop too much when you're day trading, because it might be going down to a point where it cannot be recovered. All right, and you lose your money. Now let's look at some upsides. Daily income potential, possibly multiple times in a day. People that I know who day trade regularly, who does have securities account that exceeds 25,000, they normally do 2 to 3 trades in a day, and that's it, and they're happy. Go home, call it the rest of the day. So you could be making money multiple times throughout each day. Obviously, when you're good at day trading, you basically write your own meal ticket. Pretty much. You know, make money whenever you want, as much as you want, as long as you have the funds in your securities account to be able to take it, and you have a good style of trading. Okay, so now let's move on to number 5, the 5th trading style, which is called scalping. All right, scalping is another popular trade, and it's also one of the ways that I typically trade in the stock market is scalping. When you're scalping, you're in a position 5 to 20 minutes. Some people would say 30 minutes. It really depends on once again, these time frames can fluctuate depending on who you talk with. It's also popular, just like day trading, because you're making money every single day. Normally, for me, my profit target when I'm scalping is anywhere from 10 cents up to $1.50. All right, that's what I'm looking for my profit target. Now let's look at some of the downsides with scalping. Definitely subject to the PTD rule. You can only scalp 3 times within a 5-day period because of the PTD rule. Also, there is no room for downturn. As soon as the stock starts going down, that's when you come out. The whole purpose of scalping is that you are riding a wave going up. All right, and we'll go more into the trends and the time frames. I'll cover this a little bit more with scalping. Other downside, you need to buy a lot of shares to make it worth your while, because the amount of because you're looking for like anywhere from 10 cents to $1.50, maybe $2 profit target. In order for it to actually count, you need to buy a whole bunch of shares to make it work. Most people, if they're gonna make a living off of scalping, is gonna have over $25,000 in their securities, because usually you're gonna be buying anywhere from 1,000 to maybe 5,000 shares at a time to make it worth your while. Okay, now let's look at some upsides. multiple opportunities for daily income. I know people that scalp, that's all they do, and they will scalp anywhere from 5 to 10 times in a day and call it a day. 5 to 10 times in a day. Keep in mind, folks, scalping can be considered one of the easiest ways to trade because you're only riding the wave up for a short amount of time. For a very short amount of time. And you know, as long as you are going in at the bottom of that wave and coming out before, you know, at the top, you are going to lose a little bit. It is going to drop a little bit, and then you're gonna sell. But you're doing this constantly throughout the day. It adds up. It all adds up. And folks, that's it. That's the 5 trading styles of the stock market. Take the time to really pay attention to who you are, your lifestyle, and which one most suits you, and also try to figure out which one are you most attractive to, because it's very important to know which one you like and which one you can do, and know the difference between the two. All right, so now let's take a look at trends. When it comes to the stock market, there is 3 types of trends. Okay, we have an upward trend, also known as a bullish trend. And the reason why it's called a bullish trend is it emulates, or it looks at how a bull attacks, usually with the horn and the head down and moving upward is how you attack. It's how a bull attacks, which is why it's called a bullish trend or a bull trend. Another trend is a downward trend, also known as a bearish trend. Once again, it's called a bearish trend based on how a bear attacks, which is paws up, swinging down, which is why it's called a bearish trend. Now, one thing that most people don't know, there is a third trend, and that is called the sideways trend. We pretty much looked at this trend when we looked at the WWE. We kind of touched on that a little bit. Let me go back to that WWE. This right here, let me draw this out. This can be considered a sideways trend. It's not really, let me close that better here. Here we go. Not really making headways up or down, kind of just staying in this little zone right here. Now you can still make money on this, especially if you're scalping, it doesn't matter. You know, or even if you're day trading, you can see you can still make potential of making some money. Even in a small swing trade, you can make money on a sideways trend. But for investment trading, it's horrible. This is horrible for investment trading. This is also horrible for position trading because you're not making the maximum profit that you can make. All right. Now, while we're at it here, this right here is considered a downward trend. See here, downward trends are defined as creating lower lows and lower highs. As you can see here, the highs keep getting lower and lower. The lows are getting lower and lower. And then this right here is called an upward trend. As you can see here, stock is performing higher highs and higher lows. That is a definition of an upward trend. And even though it pulls back a little bit, you still see it going up. And even here, like you see it go up a little bit, but it's predominantly going down. It pulls up a little bit, predominantly going down. Very important to be able to determine what type of trend a stock is in before you jump in on it. This is the fundamental root of all trading decisions, is knowing the trend of the stock. All right? Very, very important to know the trend of the stock before you go in. Now, why is it important to know the downward trend of the stock? Now, upward trend is obvious, right? Buy low, right? In this case, we would buy this stock at $84.35, and then you sell high, which in this case is $100.59, right? So it's important to know this because you want to make sure that you're going in on an upward trend. But why do you want to know if it's going downwards? Well, folks, most people don't know this, but you can make money on stocks if the stock is going down. Let me give you a quick example of this. Let's look at Lululemon, for example. And I'm going to go over to this trade tab up here. And I want you to pay attention to these three words. It's called EBT, which is called easy to borrow. All right? Why is that significant? Why is that easy to borrow so significant? It's significant because if I get into Lululemon here, instead of buying in, I'm gonna sell in, right? So I'm doing a reverse play here. I'm coming in selling at this stock right here, right at 139.62, and I will end up buying. Let's say this was it right here. End up selling perfectly right here, or even right here. Either one of these two, right? I sell at here, or actually I close it by buying. So you open the position by selling first, let it go down, and then you buy it here. It's a reverse play. It's pretty much as if the stock was doing the complete opposite, and you could still make money. This strategy is called shorting a stock, right? Now, another way that people can make money with a stock going down is if you are buying put options. Put options is options where you are banking on the stock to go down to make money, right? You can also make money going this way with put options. I will definitely do a series. I will do a video on options, introduction to options trading later on down the road after I'm done with this series. But those are two ways that you can easily make money when the stock is going down, right? And also the third way to know why, a third reason to know why the stock is going down is if you are in a stock going up, you want to know when to jump ship. You want to know when to jump ship, which is why you want to know when it's turning into a downward trend, which we kind of covered candlestick patterns in part 2, where you can see the trade, the trend of the trade switching from an upward trend to a downward trend and vice versa. All right, if you haven't had time, definitely take a look at part 2. Now, let's put all of this together. Let's say I'm doing an investment trade on Lululemon. I would like to see how Lululemon has been behaving for the last 10 years monthly. So I would go here, right? As you can see, I changed it to a 10-year, 1-month chart, right? Very important when you're looking at the chart time frame. Understand that it changes depending on the time frame. We were looking at Lululemon. We were looking at the 2-year, 1 day, and it looks horrible within the day period, right? It's hard to really make much assessment. It's like real wild, right? But overall, it's going up, right? But if you're looking to position trade, you can use this, and actually the day chart is how I mainly start all of my analysis, right? But if I'm going in for an investment, I know I'm going to be in there for a long time with Lululemon, I want to start here. Now, as I just said, the day chart is where I mostly go. 2-year, 1 day, having a good look at how the stock is performing for the last 2 years. because that's my confirmation of, okay, this is a good stock to get in. All right. Now, if you're day trading, you can use this, but most people tend to use a 4-hour chart in day trading. And as you can see, it looks totally different. Same stock, but the time frame that you are using changes the whole scenario. If you're looking to day trade, you want to do 4 hours, or you want to do I don't have it in here. Let me add it. Intraday. We're going to do intraday 2 hours. One day 2-hour charts, which will look more like this. Actually, you know what? Let me stretch this out a bit more. 1 day 2 hours. Let's make it a 20-day 2-hour chart. There we go. So looking at the chart every 2 hours gives you a good idea of when to go in if you're doing a day trade. 2 hours or 4 hours, but you always want to start off with the daily chart to give you a good idea that it is going on an upward trend, right? Because you want to make sure that you are going into something that's most likely going to be profitable. All right. Now, if you are scalping, I would go no less than a 5-minute chart, 1 day 5-minute chart, because what you're doing within that day is you're looking for that upward trend like this. You would jump in here, and these, in like, each time frame, the candlesticks mean something different. So now each of these candlesticks represent 5 minutes. Right? So you're looking at here. You might jump out here. Like I said, very little forgiveness. Now, I know some people that would wait 3 before they make their decision, but I jump out immediately when I'm swing trading. I'm scalping. And you want to ride this wave. You want to definitely ride this wave going up when you're scalping. You want to ride this wave going up when you're scalping. So you can see here, you won't even, usually with scalping, you don't even have to jump from stock to stock, because every day, every minute of the day, every stock, whether it's on an upward trend or a serious downward trend, is always going to have these. Like, let's look at WWE, for example. Oh, hold on. WWE. As you can see, now going out into the year, as you can see here, WWE is in a serious downward trend, right? In a serious downward trend. But once you go into that 5-minute chart, you see how you can still make profit? You can still ride WWE, even though it's going on a serious downward trend right now. You can ride this wave within the day. You can ride this wave within the day. All right. Also very important, as you can see, the time frame that I use for the candlestick shows you a different picture each time. All right, so 1 year, 2 days, you can see downward. 3-year weekly, you can generally see the same thing. But however long you're planning on keeping the stock or going into the position, that is normally the time frame you want to use for your candlestick chart. If I'm day trading, I'm looking at 2 hours. I know some people that will do intraday, 1 day, 1 hour. This is another good candlestick if you're day trading. 1 day, 1 hour. Let's look. Got a few examples here. So you're seeing how the stock is behaving within that day, every hour. You can definitely make decisions just by this alone. Here's a good example right here. Starbucks. I had this one here, but you saw the pressure to go up on this candlestick as we showed in part 1 and part 2 when we talked about what this means. Pressure to go up. Look at it the next hour. I would jump in right here because this would be the confirmation and I would make my money. Just that simple. Like I said, folks, it's not rocket science. It's not rocket science to succeed in the stock market. You just need to know and have the information in hand to make the right decisions. Well, folks, that's it. That's all I got for you for part 3 of a basic and effective technical analysis system. Come back here on Wednesday. We will do part 4. It will be exciting. When we get into part 4, we're going to get more into nitty gritty. We're going to be looking more at charts and less PowerPoint presentations from this point forward. Hopefully, because we're going to look more into the practicalities of things. Okay. Well, folks, I hope you learned. Once again, I hope you found this valuable. Hit the like, subscribe, and alerts down at the bottom. And I will see you all on Wednesday.